Business Book Summaries. Welcome to Business Book Summaries, where we present an accessible summary of The Intelligent Investor, authored by Benjamin Graham in 1949. This comprehensive guide, spanning 640 pages, stems from the wisdom of Benjamin Graham, a revered investment advisor of the 20th century. His philosophy on value investing, designed to shield individuals from avoidable mistakes and guide them in crafting effective long-term strategies, has solidified the intelligent investor as a stock market Bible since its initial release. Over the passage of time, market shifts have consistently affirmed the reliability of Graham's strategies while staying true to his original concepts. Without further delay, let's dive into the enlightening pages of our summary for the intelligent investor. Chapter 1: Investment V's. Speculation and the defensive V's. Enterprising investor. Within this chapter, Graham draws a clear line between investment and speculation. He defines investment as a thoroughly analyzed endeavor that assures safety and reasonable returns. In contrast, speculation involves greater risks taken without in-depth analysis. Furthermore, Graham introduces the distinction between defensive and enterprising investors. The defensive investor prioritizes caution and safety, while the enterprising investor is more open to risk, seeking potentially higher gains. This is an essential idea in his approach, distinguishing between smart investing and speculation. He emphasizes that investments should ensure the safety of your initial money and provide a reasonable return. Any operations that don't meet these criteria are speculative, which means they involve more risk. Graham believes in this concept strongly, and he often talks about the difference between intelligent investing and speculation. He considers three key aspects for investments: carefully studying companies using fundamental analysis, safeguarding your resources against unforeseen issues, and aiming for a satisfactory, though not necessarily exceptional, performance. Graham outlines two potential ways to approach investing. The first is the defensive approach. If you follow this, you're mostly interested in safety, past successes, and minimizing any hassle. The second is the enterprising approach. This one requires a lot of time and effort in your investment activities. It's mentally and physically demanding, as it involves in-depth engagement. The defensive approach is emotionally tough because it asks you to detach from market fluctuations and avoid panicking. It's important to note that these approaches aren't just either-or. You can find a mix that matches your personality and preferences. Chapter 2: The Investor and Inflation. In this chapter, Graham discusses the importance of understanding inflation. He emphasizes that when you measure how successful your investments are, it's not just about how much you earn, but how much you keep after considering the effects of inflation. Inflation, which is the increase in prices over time, is a constant factor that needs to be included in your risk analysis. However, stocks tend to outperform inflation around 80% of the time. To protect yourself against the impact of inflation, you can diversify beyond stocks into other investments like real estate through real estate investment trusts and treasury inflation-protected securities. Chapter 3: Stock Market Histories. This chapter explains a common mistake people make trying to predict the future, especially future stock prices, solely based on past trends. Graham points out the reasons behind this mistake: getting caught up in the excitement of a strong market, relying too much on so-called experts, and neglecting to do their own research. He highlights the importance of staying humble when trying to predict the future. Graham emphasizes that the value of any investment is determined by the price you pay for it. This idea holds true regardless of the investment type. The price you pay is a critical factor in evaluating an investment's value. This principle should always guide your investment decisions. These chapters cover principles for defensive investors. Deciding how cautious or active you should be in your investment approach shouldn't be based on how much risk you're willing to take. Instead, it should depend on how much time and effort you can dedicate to managing your investments. Your age isn't the main factor in determining your risk tolerance. It's your life circumstances. For example, if you have dependents or if you're self-employed, these factors matter more. Graham strongly advises that everyone should allocate at least 25% of their investments into bonds. This cushion, he argues, provides the confidence to keep the remaining money in stocks even during market declines. He suggests that you limit your stock investments to a maximum of 75% of your total assets. Graham also warns about the pitfalls of becoming complacent with familiar stocks, which can lead to lazy investing behavior. He cautions against buying stocks in tiny bits over a long period, as it can create tax complications if you don't meticulously track your purchases. It's not wise to invest in just one stock or a small number of stocks. Graham recommends holding between 10 to 30 stocks. This range helps diversify your portfolio, reducing the risk of being overly exposed to a single industry. If you find yourself frequently trading or spending a significant amount of time on your investments, you might be on the wrong track. Graham advises that once you've set up your investment strategy, it shouldn't require constant adjustments or excessive time. The convenience of online trading platforms shouldn't tempt you into becoming a speculator, someone who makes risky short-term bets. Chapter 6 and 7: Portfolio Strategy for the Enterprising Investor. In these chapters, Graham advises against day trading, which comes with a high level of risk. He suggests steering clear of IPOs, initial public offerings, as they often tend to be overpriced. He offers a clever way to remember this. IPP, O can stand for, it's probably overpriced. Be cautious with junk bonds. They should be viewed skeptically. When considering foreign bonds, exercise extreme caution due to potential risks. Your operating expenses for managing investments should be kept under 25%. Graham points out that even if a company is great, it doesn't automatically make it a great investment if you pay too much for its stock. He highlights that as companies grow bigger, their growth tends to slow down. When the price-to-earnings ratio goes above 25 to 30, it indicates higher risk. Look for opportunities when a company temporarily falls out of favor, allowing you to buy its stock at a good price. For enterprising investors, it's not about jumping on the bandwagon when popular stocks are soaring. Instead, the smart move is to get interested when things go wrong. Diversifying your investments is crucial. Also, consider buying foreign stocks because the future is uncertain, both at home and abroad. Chapter 8: The Investor and Market Fluctuations. This chapter covers the paradox that successful companies often experience greater fluctuations in their stock prices. Graham notes that a stock doesn't become a solid investment just because its price is close to its asset value. Investors should demand more a satisfactory ratio of earnings to price, a strong financial position, and the prospect of maintaining earnings over time. Here, Graham explains the difference between investment and speculation. Speculators aim to predict and profit from market ups and downs, while investors focus on acquiring suitable securities at reasonable prices. He advises those who want to speculate to do so with awareness, knowing that they might eventually lose money. It's essential to clearly separate speculative activities from your core investment strategy. Chapter 9: Investing in Investment Funds. This chapter talks about investment funds and what to consider when looking into them. The key takeaways are that the average fund usually doesn't choose stocks well enough to overcome the costs of researching and trading them. The higher the expenses of a fund, the lower its returns tend to be. If a fund trades its stocks frequently, it often earns less. High volatility funds that have big ups and downs are unlikely to continue like that. Funds with high past returns are also unlikely to remain winners for a long time. Graham later suggested that index funds are the best choice for individual investors. Warren Buffett agrees with this idea. The chapter explores mutual funds and what to look for when picking one. Good signs are when the managers are the main shareholders. The fees are low, they dare to be different, and they limit the number of clients they take on. Chapter 10. The Investor and His Advisors. This chapter discusses how to find and choose help for your investments. The main idea is that if you don't have at least $100,000 to invest, seeking a full-time financial advisor might not be the best choice. Until you reach that point, Graham suggests low-cost index funds. When picking an advisor, you should ask about their investment philosophy, whether they focus only on managing assets or also advise on other financial aspects like taxes, estate planning, retirement, planning, budgeting, debt management, and insurance. You should find out if they use stocks or mutual funds, how they'll track your progress, and if they provide a checklist to monitor your financial plan's implementation. If an advisor uses technical analysis or market timing, it could be a sign that they might not be the best fit. Some warning signs for advisors include high fees that take up more than 1% of your assets annually, promising returns higher than 10%, and not showing you their Form ADV, which is a professional requirement. Chapter 11 and 12. Security Analysis for the Lay Investor. In these chapters, Graham talks about security analysis, which is about figuring out the value of a stock and comparing it to its current price to decide if it's worth buying. Graham emphasizes that if any kind of security analysis gets too complicated, it's likely not reliable. To avoid paying too much for a company, you should consider factors like the company's long-term potential, the quality of its management, its financial strength, its history of paying dividends, and its current dividend rate. Chapter 14 and 15. Stock Selection for the Defensive and Enterprising Investor. The approach for enterprising investors is similar to that of defensive investors, but with more flexibility. Both should use tests to assess the quality and reasonableness of prices. Enterprising investors can be a bit more adaptable. For instance, they can allow some positive aspects to balance out minor negatives. Guidelines for enterprising investors are quite like those for defensive investors, but with a bit more room for flexibility. These guidelines include looking at the company's financial condition, earnings stability, dividend history, earnings growth, and the stock's price in relation to its net tangible assets. Chapter 16. Convertible Issues and Warrants. This chapter explores convertible bonds. These are investments that act like bonds, but can be turned into company stocks according to a set ratio. Convertibles might seem like a mix of the best of both worlds, but Graham points out that they offer less income and more risk compared to most other bonds. Unless you're determined to only invest in bonds, convertible bonds might not be the best choice. They can be complex and come with potential downsides that might not make them worth it in the long run. Chapter 19. Shareholders and Management. In this chapter, Graham explains the concept of a stock split, technically called a stock dividend. This action changes the structure of common stock, usually by lowering the stock price, making it more appealing to both existing and new shareholders. Graham also discusses proper stock dividends, which are payments made to shareholders as tangible proof of company earnings. He suggests that shareholders should expect either a regular dividend payout or clear evidence that reinvested profits have led to a significant increase in per-share earnings. Chapter 20. Margin of Safety. The central idea in this chapter is Graham's concept of the margin of safety. He bases this idea on arithmetic reasoning from statistical data and understanding the true value of investments. The intelligent investor must focus on accurate analysis and also be prepared for the likelihood of making mistakes. For ordinary stocks bought as investments under normal conditions, the margin of safety is in the expected earnings being significantly higher than bond yields. This concept becomes even more pronounced when applied to undervalued or bargain securities. In such cases, the difference between the price and the indicated or true value is the safety margin. There's a logical connection between the margin of safety and diversification. The margin only improves the odds of profit, not eliminating the possibility of loss. That's a wrap on The Intelligent Investor by Benjamin Graham. Remember to subscribe to our channel for more summaries and visit our channel Business Book Summaries. To get the book, the link is in the description. Thanks for watching, and I hope you've gained valuable insights. Now go ahead, invest wisely, and have an amazing day.